This week's podcast is sponsored by Montclair State University. Located just 12 miles from New York City, Montclair State University is a public research university that's helping students get from where they are now to where they want to be. Nationally ranked for social mobility and Washington Monthly's #1 public institution in New Jersey, Montclair is the state's premier public service institution. Learn more about what makes Montclair a university on the rise at montclair.edu. Hello, and welcome to the Washington Monthly. I'm your host, Ann Kim.
And I'm your co-host, Garrett Epps.
In this week's episode, will Trump's chaotic policies cause an economic downturn?
We are talking about the fundamental stability of the U.S. economy. In a worst case, but clearly plausible scenario, we will have our third financial crisis in 18 years.
Our guest is economist Robert Shapiro. Rob is a Washington Monthly contributing writer. He's also chairman of the economic consulting firm Sonecon and a senior fellow at Georgetown University's McDonough School of Business. My co-host Garrett Epps is away on break. Welcome, Rob. It is great to see you again.
It's great to be with you, Ann.
Well, you were on the show a few months back, actually, at the start of the Trump administration. And in fact, you were one of our very first guests. So thank you very much for returning. Well, I want to ask you first about your most recent piece for the Monthly, which was titled, "Trump's Budget Could Break the Economy," which sounds pretty dire. And you conclude that, for once, the deficit hawks are right. So by that phrasing, I take it that you haven't always been one of those deficit hawks in the past. So what has changed in your mind? What is in the One Big Beautiful Bill Act that worries you so much?
Deficits that are equivalent to 7% of GDP. That's what bothers me.
Can you explain? Explain the impact of that. What does that mean?
Yes. Well, for some perspective, in the 1990s, the deficit averaged about 2% of GDP. From 2000 to 2007, it was 1.2% of GDP. Following the financial crisis and through Trump's first term, it averaged 3.6% of GDP. We are now at double the highest rate we've seen in a non-recessionary year, I believe, in our history since World War II. And the problem is that deficits have to be funded by somebody's savings because they can't be funded by somebody's consumption. And all income goes to either consumption or savings. Well, American households save about 4 or 4.1% of their total disposable income on
That's
savings.
less than 7, basically, is what you're...
Plus, businesses save. Business saving is retained earnings, and that's about 3%, or about 3.6%, I believe. Consequently, all annual savings in the U.S. economy comes to 7.7% of GDP. Well, if the Treasury is claiming 7% of GDP, that means there's nothing left for business investment, there's nothing left for mortgages, there's nothing left for car loans, or very little, and interest rates spike. However, we don't only depend on domestic savings. We live in a global economy, and foreign governments and foreign investors invest in our securities and our economy. Right now, foreign investors and governments own 33% of our national debt, Treasury securities. They also own 30% of all corporate debt. That's all commercial paper. They also own 27% of all U.S. stocks on all exchanges. So this is how dependent we are on foreign investors. Well, we've gotten through this because our deficits were a much more modest share of GDP. That ended with Trump's budget program. There'll be 7% of GDP next year and every year for the next 5 years. And that's assuming we have relatively stable economic times. And that means we are totally dependent on foreign investors to fund business investment, car loans, mortgages, credit card debt, all annual debt that occurs next year and each year for the next 5 years. Well, these are less point to kind of close the argument. These are the countries that Trump is trying to punish with tariffs. He is playing a very dangerous game of chicken. Is all they have to do is they don't have to start selling their treasury securities. Is all they have to do is significantly slow their purchases. And that will send interest rates across the board substantially higher, slowing the economy. If they were to stop buying U.S. securities, if they were to call Trump's bluff, the U.S. economy would crash because interest rates would skyrocket. So that's where we are. It's just the numbers. This is not an interpretation.
Yeah. Yeah. Can you, just for our listeners, can you explain the mechanism by which slowing sales or an outright stoppage of treasury securities will cause interest rates to spike? And we have to pay interest when people borrow money from us. And when people aren't buying, we have to continue raising interest rates in order to entice more people in with higher yields. Is that what's going on, or what would happen?
That is exactly what will go on. If say China were to say, we're not going to buy any more treasury securities this year, in order to attract other foreign investors, we would have to raise interest rates in order to make it worth their while. There are other economic consequences as well, which we're already seeing. The value of the dollar. Mm-hmm. Normally, when interest rates go up, the value of the dollar goes up. That has not happened. The value of the dollar has fallen 20% against a trade-weighted currency basket since Trump took office. And that means that foreign investors are losing interest, I believe, mainly in investing in corporate paper and in stocks. We haven't seen that in the stock market yet, though we did see it once. Japan, for about a week, said, we're not going to invest in the U.S. And this was an initial response to the tariffs. Liberation Day, right? And the stock market lost thousands of points, I think 4,000 points. So this is the kind of thing you don't take risks with, because we are talking about the fundamental stability of the U.S. economy. In a worst case, but clearly plausible scenario, we will have our third financial crisis in 18 years. Okay. Just in the numbers. And, look, this is in part because the deficit hawks have been wrong consistently. They were wrong post-financial crisis when they called for austerity. We didn't get austerity, but Biden did bring down the deficit. They said the same thing for Trump's first budget. They said the same thing for Biden's stimulus. And they were wrong. They were wrong in large part because under Biden, because the economy was so outperforming other major economies that everybody wanted the returns. Mm-hmm. They're right this time because the deficits are so historically high. And I did read somewhere that the interest on the debt alone is more than what we spend on the U.S. military or the federal share of Medicaid. I mean, it's going to be, it already is an enormous amount of the federal budget, but it's going to be even bigger. $1 trillion in interest. And so we are also find ourselves in a period in which the interest on the debt is compounding at a fast rate because the budget deficit and the interest are growing faster than the economy. And just to emphasize your point about the foreign holdings in the United States, this is interest that is going to countries like China who hold our debt. This is interest payments going to countries like Japan or the UK or whoever holds, whoever that we're dependent upon. 1/3 of that interest is going abroad. We are sending abroad, over $300 billion in interest. That's more than our trade deficit with China. So it's, but President Trump simply does not understand the way economies operate. And he is surrounded by advisors who don't tell him. The only thing that will correct this policy is when the costs become a huge political issue. Sometimes how I think of it is the United States has always depended on the kindness of strangers to finance its business investment and deficits and mortgages. That's, look, it may be that countries that are major buyers of U.S. public and private securities say to themselves, our holdings are so large that we will take enormous losses if the U.S. economy breaks down. And so they give us slack. Well, that's when you are attacking all those countries politically and economically, you are depending on what may very well be a slim read. If they don't say, well, we're going to give you slack, then we pay a terrible price. The American people will pay a terrible price because, we talk about interest rates. Well, the first casualty of spiking interest rates is employment and the income of American workers. So this is not simply about what the yield curve shows. I think everybody is kind of living right now in a fool's paradise, again, because the deficit hawks have always been wrong before.
Mm-hmm. Mm-hmm. Yeah.
And so, first we had progressives under Biden saying deficits don't matter. Modern monetary theory, which is not a theory, it's a collection of baseless claims, says we can run any deficit because we can always print the money to cover them. Well, that's what the Republicans are now saying. And unfortunately, the economy doesn't pay attention to spin. It goes on its course.
Yeah.
And they are really playing with fire.
You mentioned the Fed, so I want to ask about the Fed in a bit, but let's turn also to some other potential threats to the economy. We've talked about the deficit. We've talked about the falling dollar. When you were on the show a few months back, you also talked about some inflationary pressures, additional inflationary pressures posed by the tariffs, but also Trump's immigration policies. So
Yes.
What is your thinking now on what the impact of these policies has been 6 months into the administration?
Well, we had seen inflation steadily move down, and it stopped moving down and has begun to move up. And we have not seen the full brunt of the tariffs in inflation for two reasons. One is lots of businesses stockpiled inventories. And half of our imports are inputs for U.S. manufacturing, and half of them are goods and services, finished goods and services.
Mm-hmm.
And there was a lot of stockpiling. You can't stockpile the services, but you can stockpile everything else. And the other is that companies have been reluctant, large companies, particularly on large ticket items like autos. They have been reluctant to raise prices, despite the fact we've had high tariffs on cars throughout this period, Trump's period, 25% tariffs on cars and auto parts. But it was because of Taco. That is the notion that Trump always chickens out. And that's because he has gone back and forth so many times on tariffs. And so a company like Ford or BMW that are making cars in the United States, they've been reluctant to alienate people, customers, by raising prices right now until they see what the final lay of the land is. Mm-hmm. Well, that's running out. The inventories are running out. And it's become clear that we will have substantially higher tariffs, certainly than, we had an average 2% tariff rate before Trump. We are now at 15 to 20%. And we'll see where it comes out. But wherever it comes out, about a third of it will go into higher prices.
Right. So the latest quote unquote agreement deal, whatever you want to call it, with Japan sets a baseline of 15%. And the Trump administration is spinning this as a victory when the original tariff rate was a lot lower than that, right?
Yes. The original tariff rate with Japan, I think, was about 3%. So it's 5 times. And we haven't heard the details. There's the largest selling auto company in the United States is Toyota. Most of those cars are made in the United States, but they're made with parts or they are made in Mexico or Canada. And made with parts from Japan and from many other countries. So we haven't seen we don't know what the tariff rate on autos and auto parts in this. It's not a deal. It's an agreement to continue to negotiate, is what it really is. We haven't seen what that will be. And on deportation, we are beginning to see increases in the cost of domestically produced fruits and vegetables, because it's not just the deportations, it's the fear, the atmosphere of fear that they've created, which they are creating deliberately. That is their cruelty is intentional, because it's meant to scare people into self-deporting, as they call it. And we're also seeing this in construction. There are the largest number and share of undocumented immigrants is in construction, and second in personal services. Agriculture is actually fourth or fifth. And so it means that, some people are being deported. A lot of other people are staying away from the jobs out of fear that ICE will find them. And it's not just unauthorized immigrants, because this campaign does not distinguish between authorized and unauthorized. It arrests people based almost entirely on racial profiling.
Yeah. And he's converting authorized immigrants into unauthorized immigrants by revoking temporary protected status, for instance, and threatening to revoke visas for others.
Right. And so, we will continue to see some cost push inflation from employment. And, the number of net new jobs, we're still creating net new jobs, but at a significantly slower rate than we did last year. So we are seeing, I believe, some impact in employment. There are very few things that virtually all economists have agreed on. On tariffs, the destructiveness of tariffs for both sides is the only thing that Adam Smith and Karl Marx agreed on. The only thing that John Maynard Keynes and Friedrich Hayek agreed on. And I certainly know that Adam Smith was a supporter of immigration. Why? Because growth rate is increase in employment times productivity increase. That's what growth is. That's the formula.
Yeah.
And so a formula that Adam Smith, John Maynard Keynes, Friedrich Hayek, Karl Marx, John Stuart Mill, Milton Friedman, all agreed on.
But not Trump.
Not Trump.
So,
Trump supports it.
Yeah. So I want to ask about, as if we didn't need any more nails in this coffin, there is one more that I want to ask you about, and that is the independence of the Fed and the threats to that. So Rob, you were a senior official in the Clinton administration. You've been an economist for decades. You've dealt with presidents. You've dealt with Fed officials. But I don't know if you've ever seen anything like the threats that Trump has leveled against Chairman Powell. In fact, I've got a clip here from just last week that I want to share with you to get your thoughts.
We have a bad Fed chairman, really bad. if he would lower the rates, and I tried being nice to the guy, it doesn't help. He's like a knucklehead. Oh, he's a knucklehead. Stupid guy. He really is.
Yeah.
Well, he's the guy who the financial markets trust deeply. And no, we've never seen anything like this except by Trump in his first term when he attacked Janet Yellen.
Hmm.
And later when he attacked Jerome Powell. Later in his administration. He has this notion that that if you cut interest rates, growth will increase. Well, that's true unless you have significant inflationary pressures and a strong economy.
Mm-hmm.
We have a weak economy. Look, the first quarter, the economy contracted. After growing at a 2.8% rate in the preceding quarter, the last quarter of the last administration. Biden may have gotten some things wrong, but he didn't get the economy wrong. Under those conditions, no Fed chair who cares about his reputation or her reputation would cut rates. I think that what he's doing is making the Fed chair a poison chalice for whoever he nominates. He is only going to nominate a loyalist, which means it's down to Bessent, Kevin Hassett, or some other loyalist in finance who we're not looking at. And the markets will assume that the Fed chair will not be independent. And the markets know that Trump doesn't understand how markets work. And so I think you will get a negative response to virtually anyone he names. And I think you'll see that response begin to kick in as we approach the time when he announces who he's going to nominate. The markets are going to build in the expectation that the policy will be inflationary. And so before the Fed does anything, there will be a lot of upward pressure on interest rates and consequently downward pressure on employment and incomes and growth.
And that brings us back full circle again to the impact of the non-independence of the Fed on foreign investors and their willingness to continue financing our debt, right? I mean, this is just one more thing feeding into that horrific cycle that you described at the top of this episode that is bound to crash the economy sooner or later.
It certainly feeds into all the deficit-based pressures on interest rates and consequently on the economy. This is an economy that runs on credit. Every part of it runs on credit. That's why we're big. That's why we're a rich economy. And, Trump seems to believe that by force of will, he can mold reality to whatever he wants. And that's true in the responses of the people who surround him. And he's achieved that because he governs and manages by threat and intimidation. It's the responsibility of a responsible and mature person in those positions to step back and say, well, this feels good, but I have to govern in the interests of the country based on the evidence and everything we know about whatever the subject is, because that's why I'm here. I'm here as an act of patriotism. That's something that Trump and sadly the people around him don't seem to understand or care about.
Yeah. I have one final question for you if you have time. Do you think that what's going to happen with the U.S. economy is a slow downturn, like a balloon losing air, we deflate over time, or are we going to see a crash? What's the more likely scenario, you think, if that's even predictable?
It's predictable in a general sense. Crashes require shocks. Something has to shock the economy. And the reason you get a crash from a shock is that it wasn't expected. And so you didn't do anything to prepare prepare for, either individuals or businesses. And because shock creates enormous uncertainty. The example I like to use is what happened to Lehman Brothers as opposed to what happened to General Motors. They both went bankrupt. One destabilized the U.S. and the global economy, or was part of a shock that did so. The other, we saw it coming, we took steps to prepare for it, there was no shock. And what I've been writing about most recently is the potential shock from the deficit, from the difficult. I think if our big foreign lenders either lose patience or feel that they have to take a stand for their own political interests at home, and then we get something that looks more like 2008, 2009. If we don't, I think then we get something that looks more like, in the worst case, 81, 82. That is a very serious recession, or a less serious recession, but many years of higher inflation and years of higher interest rates. So it's not only about the severity of the break. It's also about what kind of economy you have coming out of it.
On that note, thank you, Rob, and we'll look forward to seeing you again here.
Anytime. It's a pleasure.
Take care. This week's podcast is sponsored by Montclair State University. Located just 12 miles from New York City, Montclair State University is a public research university that's helping students get from where they are now to where they want to be. Nationally ranked for social mobility and Washington Monthly's #1 public institution in New Jersey, Montclair is the state's premier public service institution. Learn more about what makes Montclair a university on the rise at montclair.edu. That's it for this week from the Washington Monthly. I'm Ann Kim, and on behalf of my co-host Garrett Epps, thank you for listening. If you like what you heard, don't forget to subscribe to our channel or wherever you get your podcasts. Have a wonderful week.